What's up, everybody? Welcome to our webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today's our session is on property investment via REITs. Now, before I begin, just want to check if you can hear us, see our webcam, and see our slide. If you can hear us, see our webcam, and see our slide, please tell us where you are tuning in from. Okay, say hi to us and tell us where you are tuning in from. Test. Okay, well, hello. We have many friends from KL, PJ, Seremban, Penang, Cebu. Thank you very much for tuning in. All right, looks like sounds okay. Wow, we even have friends from Labuan. Okay, looks like sounds okay. All set. Okay, welcome everybody to this webinar brought to you by Bursa Malaysia. My name is Shane Chu. I'm the moderator for this webinar. Now, today's topic is on property investment via REITs. So REIT stands for Real Estate Investment Trust. So this is essentially an investment vehicle that allows you to own into properties that is ideally in prime locations and you can collect rental. So when the rentals comes in, they distribute to you. It is called a REIT. So today we're going to discuss exactly how REIT, what is a REIT, and then how you can receive dividend income and also make money from a real estate investment trust. So you no longer need to own property. You can also own a fraction of property via this instrument called real estate investment trust. Now, before we go on, just like to talk about disclaimer. Whatever we share on this webinar is only for educational purpose. In no way that I give any recommendation to buy or sell any REITs or any case study that we mentioned in this webinar. So in the event that you want to buy or sell any companies or REITs, you do it at your own risk. Okay. Now, allow me to introduce you our speaker today. He is Ian Tai. So he is the content producer of kclao.com, which is regarded as the #1 financial blogger in Malaysia. He has written 100 plus articles on kclao.com. He is also the regular webinar host and presenter on kclao.com. He is also the co-founder of dividendvault.com, in which he manufactured competent dividend investor who can build dividend-paying stock portfolios in Malaysia, Singapore, and Hong Kong independently. Now, he himself is a dividend investor. He invests primarily for dividend income, and he's getting an average of 4 to 8% in dividend yield per year. Now, he is definitely an expert in a real estate investment trust, and he himself has invested in quite a bit of REITs. So today, let me hand over the session to you. Ian, are you ready?
Yep. Hi, Shane. Thank you so much for your very kind and professional kind of introduction. So once again, thank you so much for letting me share a little bit about my thoughts in this particular platform lah. So hey guys, so I believe Shane, your audience is actually looking at the screen right now, right?
Yes, correct. We're looking at your screen.
Okay, so thank you so much once again, Shane, for this opportunity. And I have prepared a lot of materials for you guys, so let's just get right into it. So, okay, actually, before I actually start this presentation, right, let's just talk a little bit about property investment, okay? Because a lot of people, when they say property investment or REIT investment, all right, sometimes they say, which one is better? Is it to buy a physical property or is it better to buy a REIT? So for me, right, coming from both angles are because I'm also into, or let's say advocating people to have properties themselves, the physical ones, and I also invest in REITs myself. So I would say that it's not something which is like property investment versus REITs, but what I would say is that actually both, you can actually complement the two together to actually build a very nice investment portfolio. That means you can mix and match between REITs and property, the physical property investment. All right. So why do I say so? Simply because let's say, for example, if you're interested to actually invest in a property, all right. So basically, right now, what I can see is that the property has good value, the physical property. But at the same time, we also have to be realistic about our rental income, all right. Whereby, as you can see, most of the properties today, if you look around, you can find really good value. All right, means to say you can actually find discounted properties in the market today. All right, you can buy properties at below market value. But then the question is this: can your rental income actually cover, or can it actually totally pay off your mortgage, your maintenance fees, your cukai pintu, your cukai tanah, and all this kind of stuff? All right. Most likely, you couldn't actually do so. All right. So what happened? So if you have some spare cash, and if you, let's say, invest into a portfolio of REITs, maybe the dividend income that can be generated from these REITs, right? This dividend income, or in REIT term, we don't use the word dividends lah. All right, we will use the word income distribution. So this income that has been distributed to your bank account, what you can do with it is you can actually take this to supplement, to cover the shortfall that you may incur from your actual physical property investment. So this is actually one way to work it out. But of course, for those of you, let's say for example, I believe that Shane's audience, maybe some of your audience are quite new to investing, and maybe they are young working adults trying to save up for a property. So in that case, you may also want to consider REIT. All right, I'm not saying take all your bank account and just stash it into REITs. It doesn't work like that. But what you can say is that you may consider setting up a portfolio which consists of really good REITs. All right, and you can actually invest into it on a regular basis as long as the price is right. Later I'm going to show you how to do that. And the and then you get some dividend income, and of course if you buy it at the right price, you should get some capital appreciation, and from there you can use it as a platform to actually raise your funds for your first property. All right, and can you do it with REITs? Then my answer to you is yes. I believe that this is actually quite doable. All right, so all in all, right, what I'm saying is this: property investment better or REIT investment better? I would say both can be complementary to one another. All right, so for this purpose, because this webinar is sponsored by Bursa Malaysia, so let's just focus on REIT for today. And with that, as you can see on my screen, if you want to invest in a REIT, right, actually, whether or not you want to invest in a REIT or whether you want to invest in any stocks, right, the first question that you may want to ask is this, because a lot of people don't ask this question, which is, what exactly is your investment objectives? Well, this one I cannot answer for all of you guys, but what I can do is that I can share from my own perspective what are my own personal investment objectives. So for me, it's actually very clear because I'm a dividend investor. So my own personal investment objective is to actually invest to earn incremental dividend income. All right. So incremental means to say I like to see dividend income growing on a year-by-year basis. That means to say if 2016 I'm making certain kind of dividend income, 2017 must be a little bit better than 2016, 2018 must be better than 2017, 2019 must be better than 2018, and so on and so forth. Incremental dividend income. So this is my primary focus when it comes to building my own portfolio. All right, and because of that focus, right, so therefore I have personally actually going to use this framework. All right, that will be a very useful framework that has guided me through on two things. It has guided me in two things. Number one, it has guided me on how do I actually pick my own stocks. All right, that's the first one. And the second one is when exactly do I buy. All right, because without a framework, without a standard operating procedure, right, or the SOP, right? Okay, maybe we have heard of the word SOP. So a lot of people, they don't have SOP when it comes to investment. So if you don't have a SOP, right, then you tend to be good lah, trying all sorts of things. And personally, I find that if you don't have a SOP, right, you should actually work backwards, have an objective, set up your own framework with an SOP, because if not, right, you're just taking your money and you are just trying out you are going to just try out so many things in the stock market, and it's not so capital efficient lah. That's my own perspective. So what exactly is my framework? How does it look like? So it is actually summarized in this quadrant where it consists of 4 words. So the first one is growth, the second one is stability, the third one is valuation, and the fourth one is yield. So let's look into it. Oh, All right, so I have to actually expound into it before I look into the case study. We shouldn't be actually, I should actually review it later. But anyway, let's start off with the framework. Let's spend a little bit of time on this framework because it's very important. So for me, I will start off with the first one, which is at the top left corner, which is growth. So for me, as an investor, right, I will be looking at the business model, all right, of a stock before I actually invest my money into it. Why? Because I want to buy into a company or a stock which has a very resilient business model that has the ability to not only withstand the economic crisis, which is the second left, which is the bottom left corner, which is stability, which is stable in both good and bad economic conditions, but at the same time, it has the ability to grow, okay, which is the top right corner. So growth and stability is actually, they come as a package, all right? So a lot of people say, oh, I invest for growth, but a lot of people think, oh, investing is just about growth, nothing to do with stability. Not so, all right? To me, growth and stability is a must in any investment, all right? Simply because you want to have sustainable growth in your portfolio. If your portfolio is not sustainable, then your growth is also not so sustainable lah. All right. So how do we actually measure growth and how do we actually measure stability? Most often, what we do is that we will look into the company's financial statements or the financial results of a company to actually determine whether or not this company has the track record in the past, has the present financial strength, and has the ability to grow in the future. So these are the three things that we will be looking at very closely before we actually determine, is this the kind of stock that I want to invest into? So that's the left side of the quadrant, which is growth and stability. Very important, okay? Now, looking at the right side of the quadrant, which is valuation and yield. So for stocks, right, I tend to actually value the stock, right, based on these three valuation ratios, which is PE, PB, and dividend yield. But for REITs, right, we don't have PE lah, because for a REIT, right, the earnings is actually it can be it fluctuates according to this thing, which is the amount of capital gains it received or it recorded in a single year. All right, and it doesn't, and to me it doesn't really how do I say, it doesn't really measure the actual business performance of the REIT. All right, what do I mean by that? For example, let's say a REIT, right, is a real estate investment trust, and let's say it actually invests in a shopping mall. Okay, let's be generic about it. Let's say it's a shopping mall somewhere in Petaling Jaya. Okay, so the shopping mall can do very well, and it may perform or it may not perform. But in that particular year, let's say the valuer, right, last year it valued the property, the shopping mall, at 100 million. The next year, the property at 120 million. So it's a 20 million additional in comparison to the previous year. So that 20 million, right, will be added into the financial statement of the REIT, and therefore because of that, right, the earnings of the REIT has actually gone up by 20 million. And this 20 million, right, is just capital gains of it's just capital appreciation of that building. It is not cash. It's cash based. So because it's not cash based, any sort of dividends are. So therefore, so it's good to have it's not very part of my of my way of assessing whether or not this is a good REIT. It is, but it's not. It has a lesser scorecard lah. It has a lesser weightage in my scorecard. Let's put it that way. Okay. Don't worry. If let's say you don't understand what I say, later you just put your questions into the chat box. Both Shane and Shane will be moderating and I will be answering your questions. All right. So don't worry about that. But so anyway, back to this quadrant, right? Valuation, I will just look at PB, and then as for dividend yield, is because we don't use the word dividend, we use the word income distribution. So therefore, we'll be looking at distribution yield of a REIT. And finally, let's get into the case study. And today, of course, in Malaysia, we have about 17 REITs. All right, and to me, some of the REITs are some can be very easily assessed, like IGB REIT. So that's why I'm not choosing that as a case study, because if you can do summary REIT, then of course you can do IGB, like just a snap of your finger lah. All right, it's actually that easy. Of course, you can. Of course, there are other REITs, all right, which are pretty specific. Like for example, YTL Hospitality REIT is a hospitality REIT. And Dhaka Healthcare REIT, which is more into hospitals. Okay, so these are actually quite generic. This is one of the that is, and I believe that we can learn. Okay, so let's move on. All right, so let's look at let's actually assess Sunway REIT today based on the quadrant, all right, based on the framework that I have actually prepared. So the first quadrant that we're going to look at is growth, okay? So what I did is that the whole objective here is to see whether or not this Sunway REIT, right, the management, have they track record of growth? So that is what I want to know. What have been in the past been, they do right?
Ian,
Has there any
your audio
contribution?
is on and off. It's breaking. Your sound is breaking up. Can you? I think your internet connectivity is a little bit poor at the moment. Maybe you can turn off your webcam to see if you can. Yeah, maybe you can turn off your webcam to see if it's better.
Okay, I don't know with the presentation. All right, so continue, right?
Yes, yes,
Hello, Shane?
yes. I'm here. Yeah, you may continue.
Okay, let's continue. Okay, so let's continue. So quadrant number 1, growth. So over here, be looking at. The first one is actually past, the second one is present, and the third one is future. So when it comes to the past, right, I want to know whether the management, what they have done to actually, whether or not these people, right, have they aggressively expanded their portfolio in the past 5 to 10 years? That's what I would like to know. The second one is present, which is what exactly. The first thing is this: do they have money to expand? Let me say, as of now, as of the latest financial accounts, do they have the capacity to expand, the financial means to expand? So this is something that I would like to look into. All right, and what exactly is their immediate? What are they currently pursuing to actually grow their business? And finally, number 3, which is the future, which actually involves the management's future outlook towards the stock, towards the REIT. Are there any more room for growth? So this is actually something that I will personally look at. All right. So let's look at the past. So I have actually dig out information from Sunway REIT, and this is what I've gathered from my end. And all these things are actually based on the annual reports of Sunway REIT. So Sunway REIT, as an introduction, what I found is this lah. All right. So it has its IPO, which means it first listed on the stock exchange on Bursa Malaysia on the month of July 2010, which is like 10 years ago. So at that time, right, it was listed with 8 properties. All right. And at that time, the 8 properties the valuation is actually 3.5 billion ringgit lah. All right. So that was 10 years ago, Sunway REIT. Then after they have actually been listed on Bursa Malaysia, so the following year, which is 2011, they have invested into the Sunway Putra property at the price of 522 million. And then subsequently, the following year, which is December 2012, they have actually bought into Sunway Medical Center at the price of 313 million ringgit. And then the subsequent year, I won't say the subsequent lah. Then after that, 3 years down the road, right, which is 2013, 14, and 15, 2013 and 14, right? Actually, during this period, they are busy renovating Sunway Putra lah. All right, at the time they are refurbishing Sunway Putra. They are converting it into a much more. They're giving Sunway Putra a fresher look at the time. All right, and then 2015 is a time whereby they actually make some small investment into Sunway Hotel Georgetown for $74 million. So this one is not so substantial. Subsequently, they buy Wisma Sunway for 64 million ringgit, and this one is in Shah Alam. So this one is also a smaller investment for Sunway REIT. Then after that, during 2015, that is when they launched. They have actually refurbished Sunway Putra, and they actually launch it. All right, they go and get all the tenants and they launch it. Okay, so that is what they did in 2015. And then 2017, they started to diversify their investment into an industrial property in Shah Alam. And this one they bought it for 92 million. And after that, after 1 year later, which is 2018, they actually, I wouldn't say they buy lah, okay. Sunway Clio property, okay, for those of you who are not exactly from the Klang Valley, right? So if you have heard before Sunway Pyramid, so Sunway Clio is a property next to Sunway Pyramid. So it's like just not, I wouldn't say opposite, like it's just side by side. It's actually quite connected to Sunway Pyramid, all right. And they bought that property, which consists of 2 or 3 levels of retail outlets and a hotel. So Sunway Clio is actually mainly a hotel kind of property for 344 million. And then after that, April 2019, 1 year later, right? They actually bought over Sunway University College lah for $556 million lah. All right, so they actually bought over the college property, and then they lease it back to the college operator to run Sunway College. So because of all these investments, right, but as of June 2020, which is where the latest financial accounts is, right, they have grown their property from 8 properties to 17 properties. And then the property, right, the portfolio value, the valuation go up from 3.5 billion ringgit to 8.5 billion ringgit. So this is what I call growth trajectory. All right. So it shows to me that Sunway REIT, right, has been quite, how was it, proactive lah. All right, they have been quite proactive when it comes to pursuing growth for their own property portfolio, which is very good. Let's move on. Now, now we are actually cutting off at June 2020, where it had 17 properties worth 8.5 billion. But then the thing is this, will they actually continue to grow in the future? So what I find is this. So there are few places where they are trying to pursue growth. The first one is that they have announced that they will be buying up Sunway Pinnacle. So this Sunway Pinnacle, right? So for those of you, just now I talked about Sunway Clio. So Sunway Clio is one property, which is at one side of the how do I explain this? Okay, let's start with Sunway Pyramid. So Sunway Pyramid, all right, and it's an iconic shopping mall where it has the lion head. All right, so let's start off with the lion head. On the left hand side of the lion head, right, you have Sunway Clio property. And then on the right hand side, all right, or I would say you go a little bit right backwards, you will have all the Sunway Hotel Resort and Spa, and Menara Sunway, is it? There's a few office blocks over there, all right, also under Sunway. And then at the end of that Sunway, that whole cluster lah, they call it the Sunway City cluster, is an office building known as Sunway Pinnacle, and they buy it for 455 million ringgit. Okay, so that is Sunway Pinnacle, which is within the vicinity lah. Okay, for those of you who are not so familiar with Sunway and the Klang Valley, so it's Sunway Pinnacle is an office building within the Sunway City cluster. Now, moving on, we are going to look at Sunway Carnival. So Sunway Carnival has been a project. It is a shopping mall in Penang, and it is actually currently under expansion. And the amount of money they are going to invest is 353 million to actually expand the shopping mall, which is Sunway Carnival. They are going to build a new wing, all right, a new wing of shopping mall in that place, all right. So you may find out more about it in the annual report. So that is Sunway Carnival. And along the way, right now, somewhere between right now and 24 months down the road, they are going to refurbish Sunway Resort Hotel, and they're going to spend about 220 to 260 million ringgit on this particular project. All right, so these are their 3 main current growth initiatives at the moment they have gathered. All right, so that is actually looking into growth. Okay, so this is actually the growth of the company. Now I will be looking at the stability element of the company. So for REITs, right, this is actually quite specific for REITs. For REITs specifically, stability, right, means this. Question number one, how dependent a REIT is for its income, okay? So meaning to say, I do not like a REIT whereby the REIT, right, is so dependent on one single property for its performance. That one I don't like, okay? Like for example, there could be a REIT whereby they just have maybe just a few properties lah, all right? So meaning to say, if let's say the property is not doing well, or it has been destroyed, or something negative, or a negative thing happened to that property, right? Then I will lose bulk of the income. So that to me is not exactly stability lah. Okay, so the question of stability, right, for a REIT can come in 4 different answers. All right, or at least I use 4 different angles to actually look at the REIT stability. So the first one is the property type. The second one is the geographical location. The third one is tenants, and the fourth one is the lease structure. Okay, so let's look into one. So let's say for example, for Sunway, property type, right? Well, Sunway is actually quite diversified as a REIT because to me, right, 17 properties, what they have is that not all 17 properties are into one single category of a REIT. Okay, for example, let's say IGB REIT is a shopping mall REIT, definitely. All right, because it only has 2 shopping malls. But for Sunway, it has 4 retail malls, 6 hotels, 4 offices, 1 hospital, 1 university, and 1 industrial property. So that means you say the type of property, right, is pretty much diversified. So I think that is okay lah. All right. So for example, right now, let's say COVID-19, if you want to talk about hospitality REIT like YTL, hospitality REIT, and the hospitality industry is actually quite battered because of COVID-19. So if let's say you are solely gonna put everything into YTL hospitality REIT, then of course you're gonna get battered lah. All right, but it's not the case for Sunway because Sunway, right, hotels, they may have 6 hotels, but then the 6 hotels, right, is just a portion, not the totality, not the entire piece of their own property portfolio. So because of this, right, it gives some form of stability to Sunway REIT in comparison to YTL lah. So that is what I'm trying to say. All right, the more diversified a REIT is, the better. The better it can withstand a negative impact towards a certain asset class. All right, let's move on to number 2, which is geographical location. So most of the REIT in Malaysia, except for YTL, hospitality REIT. All right. I'm not too sure about LRCA. All right. I'm not too sure whether do they still have assets overseas. Okay. That one I have to check back the annual report. But apart from these 2 REITs, right, all the Malaysian REITs, right, they will have their properties in Malaysia, located in Malaysia, everything in Malaysia. Like Sunway REIT is all the 17 properties are located in Malaysia. So which means it's all dependent solely on the Malaysian economy. All right. So this is actually so if you decide to invest in a Malaysian REIT, so this is actually the thing that you may be facing lah. The geographical location, Malaysia. Of course, I won't be talking about Singapore REITs and Hong Kong REITs and stuff like that. Okay, so that one is for another webinar. This is for Bursa Malaysia. So for Malaysian REITs, Malaysian economy. Next, tenants. So for Sunway REIT, the good thing about Sunway REIT is this: it has 1,207 tenants. Meaning to say, if one tenant decided not to continue on the tenancy agreement with Sunway, not to worry, you still have 1,206 tenants where you can derive income from. So the larger the pool of tenants, the less dependent the REIT is from deriving income from that one single tenant. So to me, I look at that as a sign of stability. Okay, what I don't want is actually a REIT that depends on just maybe 1 or 2 major tenants. If the tenant happens to say, okay, you know what, I'm gonna end my tenancy agreement, I'm gonna go somewhere else. There goes your REITs. There goes your income, the source of income to the REIT, which is something that I don't like. So typically a REIT like Sunway REIT, right, or any other REITs, they will give you the top 10 tenants, the top the top 10 tenants that contributed to the REIT's gross revenue. So for Sunway REIT, the top 10 tenants, right, actually they contributed 12.9% of the gross revenue in 2020. So let's move on to the fourth one and the last one, which is lease structure. Okay, so different REITs will have different REITs will have very different lease structure because different asset classes will have very different lease agreements. For example, for retail malls, right, you can find that the lease agreements will be a bit shorter, maybe at the rate of 2 or 3 years. Every 2 or 3 years, once you'll find it has to be renewed. Okay, so for retail malls, it's actually a bit shorter. And unless you're talking about anchor tenants, maybe anchor tenants will get a much longer lease tenure. Okay, so that's retail malls. Typically, hotels will have a longer hotel wise the lease structure will be longer, maybe at the 10-year, 15-year, 20 years range. But then the thing is that their lease structure, right, sometimes it's actually based on, it depends on which hospitality REIT lah. Sometimes it can be performance based. Sometimes it can be a fixed rent based. So it depends. Okay, so that is for hotels. Usually for industrial and medical properties, their lease tenure will be much longer at 10 years. Some can be 5 years, 10 years, 15 years, and it's all based on the fixed rate with a little bit of increment on a yearly basis. So hospitals and industrial properties, right, they may have a much more stable lease structure compared to retail malls and hospitality kind of properties. And finally, we have the college, like Sunway College is Sunway University College. The lease structure is a bit even more stable lah. That one, I do not know how to put it lah. How do you actually describe a lease structure which could last 30 years? So once you sign the tenancy agreement, you actually collect rental income for the next 20 to 30 years from the tenant. So this is actually something is of a new asset class, which is university campus lah. So that is the thing about Sunway College. All right, so the deal is this: Sunway REIT buys over the properties of Sunway University College, and then they will lease it back to the Sunway College operator for a period of 30 plus years. All right, so there you go. That's income stability lah. So for Sunway REIT, it's because of the diversity in the property portfolio. So therefore, they can balance out the shorter term kind of lease structure with the longer term kind of lease structure. So overall, in average, their weighted average lease expiry as an average hold is 5.9 years lah. So the longer the better, which means today you buy, the next 5.9 years you get rental income from its existing lease agreement. So that's what it says lah. Okay. And now looking forward, and now to the next slide where I'm going to talk a little bit about Sunway's vision for the future. So when it comes to Sunway REIT's vision to the future, they call it the Transcend 2025. All right, Transcend 2025, which is like 5 years down the road. So what they do is that they intend to become the leading diversified REIT. They won't say they are the number one lah. All right, not because they don't want to, because there's another REIT called KLCC Stable Securities lah, where the property portfolio is right now at 13 to about 14 billion ringgit lah. Okay, so that's what KLCC has right now. So if I'm gonna scroll back, if I'm gonna scroll all the way back to this slide, as it stands right now, June 2020, Sunway REIT has 17 properties, which is valued at 8.5 billion ringgit. So 8.5 and the current leader of 14, right, is still far away lah. So you won't say you are the number one, but you can say you maintain your position as the top 3 REITs in Malaysia. So that's what Sunway REIT has in mind. And of course, and right now what they intend to do is that from 8.5, they try to grow their property value to 13 to 15 billion ringgit in the next 5 years. And how are they going to do that is by they want to actually increase their investments into other types of property, maybe industrial property and other segment kind of properties. Could be hospitals, could be I'm not too sure whether how many Sunway colleges do they have. But I doubted they have opened up so many Sunway University College lah. But I would say industrial is actually one of the sectors that they are looking into, because that's what it says in the annual report lah. They want to up their services kind of property, industrial kind of property to 25% of their total asset value. So maybe this is actually the asset class they are trying to increase focus on for future growth. Okay, so quadrant two, stability. So just now at quadrant one, we talked a little bit about stability. So that portion is actually talking about income stability. How stable is the income, the source of income to Sunway REIT? So this one, all right, so it's actually a sequel to that. So what we're going to do is that we are going to look at the second part of the stability equation, where we're going to talk about the financial results. Okay, so just now I talked about the business model, the growth prospect of Sunway REIT. Right now we are going to talk about financial results, where when it comes to financial results, right, there are two things that we need to look at for REITs. The first one is this. Number one is whether or not the REIT, right, is able to generate consistent profits year after year, all right, since its IPO. So that is actually the first indicator, the first thing that we look at for a REIT. The second one is actually gearing. So gearing means, okay, let's say the Sunway REIT has $8.5 billion in property value. So how much is that of that, right, is funded with debt. So that one is called gearing. And I hope that, and what we need to find out is that there is a capping lah. So for Malaysian REITs, right, the gearing ratio shouldn't be more than 50% lah. So anything below 50 is okay, but of course, to me, the lower the gearing ratio, the more stable the REIT is lah. Okay, or I would say the lower the debt, the lower the gearing ratio, which also could mean the REIT has the ability to go to the bank to borrow more money to actually buy more properties, or to fund renovation or refurbishment projects to enhance the value of their property. So the lower the debt ratio or the gearing ratio of a REIT, the more chance it will actually have the ability to fund its growth prospects. Okay, so that's how I look at the REIT. Now let's move on. So let's talk about profitability. So now I'm going to go through all these 6 things. So profitability, right, we'll look into number 1, revenue, number 2, net property income, number 3, distributable income, number 4, distribution per unit, number 5, net asset value, the 6 is gearing ratio. So the first 5 will be related to profitability. The number 6 one is gearing. So let's look into it. So over here, what we can see is that the first 3 is actually laid out over here. We have gross revenue, net property income, and distributable income. So what I will do is that I will plot the chart like this. And what I find is that, hey, you know what? Sunway REIT as a group, right, as a collective whole, has been increasing, has generated a consistent increase in gross revenue, net property income, and also distributable income for the past 7-8 years. So it has increased. So let's start off with gross revenue. Yeah, as you can see at the bar chart over here, it has increased from 406 million ringgit to 518 ringgit in 2019. Let's exclude 2020 for now. And if you look at net property income, it increased from 299 million to 440 million. And distributable income, it has increased from 202 million to 283 million. So as you can see, it has been a steady growth over the past 7 years up to 2019. And in 2020, as you can see, there is a slight drop in revenue, net property income, and as well as distributable income. All right, so why is that so? This is because, right, for Sunway REIT, especially the final part, because for Sunway REIT, the financial year end for this REIT is 30th June every year. So if you're looking at 2020, right, it consists of the financial period from 1st July 2019 to 30th June 2020. So which means during this period, the final part of this 2020, right, consists of the period of MCO. So during this MCO, so it was kind of like impacted during MCO lah, because not only it has to shut down some, it has to lock down its hotels, its shopping malls and stuff like that. You also have to give out rental relief and rental rebates to some of these tenants. And because of this, right, the income, all right, the revenue, the net property income and the distributable income of the REIT was impacted because of that. So it causes a drop or a dip in these three categories: gross revenue, net property income, and distributable income. So that is actually the case for summary REIT lah. So now let's look at next. So because of that, right, if you look at distribution per unit, it has actually increased from 7.5 cents to 9.59 cents. And then 2020, because of COVID-19, the DPU has actually dropped to 7.33 cents lah. Okay, so this is actually the financials. This is actually plucked from the financial statement of summary REIT. Okay, so this is the general record. All right, so this one I think is okay, because COVID-19, well, everyone is doing badly, so that's the case lah. But if you want to separate a good REIT from a bad REIT, like here's the thing, here's a trick that I'm like to share with you guys. Plot a bar chart graph like this, where you have the DPU of all the REITs. If you find that the REIT, right, is where the DPU is actually like this, it grew until 2019 and then it drops in 2020, that one I still think is okay. But what if you find a REIT that is like where the DPU keeps on declining year after year, even before MCO? All right, so if you find a REIT like this, right, then of course I would say that the quality of the REIT is not there lah. All right, not as good as summary REIT, because summary REIT before COVID-19, it has actually achieved growth in DPU or distribution per unit. It's only MCO they kind of like recorded a drop in DPU. But if you find other REITs where it has a declining DPU consistently over the long term, then to me that is a no-no lah. Next. So the next part that I'm going to look at is the net asset value. So this one, so how do you calculate net asset? So net asset, right, is like this. So first and foremost, you go to the balance sheet of the REIT. You have assets minus liability equals to equity. So equity is another word for equity is net asset. All right, it's actually asset that is net of the liability. All right, so net asset is actually equity. Asset minus liability equals to net asset or equity. So assets, okay, so a key factor of this is the asset. So the asset, just now what I say is that we have 17 properties worth $8.5 billion, okay? So that $8.5 billion is a big part of these total assets. If the properties in the portfolio consistently achieve capital appreciation, very good. Because if the properties inside the portfolio consistently achieve capital appreciation, it should actually boost up the net asset of the REIT. Okay, and because of that, all right, once you take the net asset, you divide it by the number of units, it should actually result in a higher net asset per unit for the REIT, as shown by summary REIT. Okay, so summary REIT, as you can see, the net asset per unit has increased from 1.1 ringgit and 10 cent to 1 ringgit and 48 cents. So I think this one is quite okay. All right, so this is a good example of a REIT where it has increased its net assets per unit. Of course, there are REITs that you can find on Bursa Malaysia where it doesn't have an increase in net assets per unit. Then you know already lah. If you compare that REIT versus summary REIT, then you know lah, summary REIT is of better quality than the REIT lah that has a declining net asset per unit. Okay, so this is how I assess the business model, the financial results, which is all mostly related to the qualitative part, the quality of the REIT, all right, which is of essence, because if you invest in a REIT that is not of good quality, chances are chances are you will actually lose money from investing your money into that kind of REIT. So don't take this lightly. The qualitative part is actually the more important part. All right. So use the first two quadrants to find good REITs, and after that, once you have a pool of good REITs, then you move on to the third quadrant, which is the valuation quadrant. So this valuation quadrant is actually very, very simple. So over here, we are going to complete this slide together. I purposely left this thing out because we are going to do this together. Okay, we are going to assess the valuation of the REIT, of Sunway REIT, as of today's closing price. Okay, so we are going to do this together. So if you want, you can actually participate this together with me. Of course, if you have a smartphone ready, you can actually put your smartphone right beside you, and we're going to do some calculation over here. So what we find is that the third quadrant is valuation, and over here we are going to not use PE ratio, we're going to use PB ratio. So PB, B stands for book value per unit. All right, so book value is also another word for net asset value. It's the same, is the same meaning. It can be used interchangeably. All right, book value per unit, net asset value per unit. So for Sunway REIT, the latest NAV, the latest net asset value is RM1.48 per unit. Okay, so now over here, I'm gonna just exit my slides. All right, and we're gonna complete this slide together. So what we are gonna do is this. Okay, we are gonna go to the Bursa Malaysia website. Click onto equities, and then let's find Sunway REIT. So over here we can see that the last done price of Sunway REIT is RM1.59. Okay, so let's use this price, RM1.59. Okay, so the current stock price right now is RM1.59. The latest net asset value per unit is RM1.48. So PB ratio is calculated by taking the current stock price, which is RM1.59. You divide it with RM1.48, and from which, let's bring out a calculator. So if we take the current price, which is RM1.59, divided by the net asset value per unit of RM1.48, you should get a PB ratio of 1.07 lah. All right. So the current PB ratio is 1.07. So is this a good deal or not? I don't know. Okay, because we need to take this current PB ratio and we need to compare it with the past valuation ratio. Okay, so over here we have found out that the current PB ratio is 1.07, and I actually calculated its past PB ratio, where I personally find that, as you can see on the screen, the current PB is 1.07, the lowest PB is 1.1, the average is 1.21, the highest is 1.31. So is this a good deal or not? Well, here's what I would say. As an investor myself, I will personally prefer to buy a REIT if, let's say, the REIT is actually trading at the price below, towards the lower part of the PB ratio, not the highest. Okay, because why? The highest PB of 1.31 represents a figure which is like overvalued to me. The average one is more like fair valuation, not too expensive, not too cheap. The lowest one at 1.1 is when the REIT is at its most undervalued. All right. So at the most undervalued for Sunway REIT is 1.1, and right now the current is 1.07. So which means it is now, according to PB, trading at below its lowest PB ratio. All right. So based on the PB ratio formula, you will find that Sunway REIT, you can say is undervalued at this point of time, based on PB. Okay. So that's how I look at. That's how I personally use the PB ratio. And with that, let's move on to quadrant number 4, which is yield. Okay. So this is actually where we are going to calculate the distribution yield of the REIT. So again, how do we calculate this? Now, this is a very funny situation because personally, right, Sunway REIT, it actually did very well until 2019, and 2020 is a very challenging year for Sunway REIT. So how do you assess this Sunway REIT? All right, how do you go about it? So if you're not too sure, what I would suggest doing is this. So you can assess the REIT, all right, based on two different sets of DPU figures. The first one, all right, you can use the before COVID-19 figure, which is the gross DPU for 2019. Okay, so this one is before COVID-19. This one is the latest year, 2020, and this one is actually represents the gross DPU after or during the MCO period. Okay, so we are going to calculate the gross distribution yield based on two different sets of figure, the 9.59 cent, which is before COVID-19, and 7.33 cent, which is after COVID-19. So let's take a look how to actually calculate this. So the current stock price right now is 1 ringgit and 59 cents. So to calculate gross distribution yield, you have to take the gross DPU, which is this, and divide by this, which is the current stock price of $1.59, and you multiply with 100%. So to illustrate, let's start off with the before COVID-19 DPU. So before COVID-19 DPU is actually 9.59 cents. So you divide it with $1.59. So right now, sorry, let's do it all over again. 0.0959 divided by 1.59. So currently your dividend yield times 100%. Your dividend yield should be 6.03%. So I'm going to just put in your gross distribution yield would be 6.03%. Okay, that is before COVID-19. And after COVID-19, if you want to calculate the DPU after COVID-19, which is like the worst case scenario, what you can do is that you can take 0.0733 divided by 1.59. So right now, at the worst case scenario, you should get a distribution yield of 4.61%. Okay. So this is actually how you calculate. But is this a good deal or not? I do not know. That's because we need to compare this. We need to compare the 6.03% and the 4.61% with the past valuation ratios. All right, so let's look at it. So the distribution yield, the gross one, all right, is 6.03%. And then after COVID-19, the distribution yield is 4.61%. Okay. So if I'm going to compare it with its past, sorry, I should actually put this in. So let me just put in the figures quickly. Okay. So if we compare it with the Sunway REIT's past distribution yield, what we'll find is this. Okay. Let's start off with the before COVID-19 case. So before COVID-19 case, the lowest distribution yield it achieved was 4.5%, 4.52%. The highest is 5.81%, and the average is 5.45%. So to interpret it, assuming there's no COVID-19, okay, assuming lah, all right. personally, if I want to invest in Sunway REIT, the minimum amount of dividend yield I can accept is 5.45% because that's the average, that's the fair valuation. I would prefer, because I'm a dividend investor, I would prefer to invest in a REIT like Sunway REIT if, let's say, I can get around 5.8%. So I think 5.8% for Sunway REIT is okay. All right. And given at the current price right now at 1.59, the current distribution yield, all right, assuming there's no COVID-19 at 1 ringgit and 59 cents, that's the stock price of today, it can give me 6.03%, all right, which is higher than the highest dividend yield that has ever achieved since IPO. So that's okay. Now, if you want to be really, how do I say, if you want to be really tight about this and you want to factor in the after COVID-19 case, all right, the lowest is still 4.52. The average is 5.35, which is not too far away from the 5.45% before COVID-19. The highest is still 5.81. Right now, assuming that COVID-19 persists, most likely, all right, based on, if let's say Sunway REIT can actually maintain the 7.33%, 7.33 cent in gross DPU, your current distribution yield should be 4.61%. All right, so these are all gross figures. And now let's put all of them together. Okay. Now, before I put all of them together, there's one more thing that I would like to highlight. So does that mean that right now, if you buy Sunway REIT at 1 ringgit and 59 cents, you're going to get 6.03%, assuming there's no COVID-19? The answer is no. Why? This is because in Malaysia, Malaysian REITs, right, we have this thing called the withholding tax. And if you're an individual investor like me, your distribution, right, it consists of two parts, all right? The first part will be the taxable part of the income the taxable part of the income distribution, and the second part will be the non-taxable part of the income distribution. The non-taxable portion, you get it in full, 100%. The taxable part, all right, it will be subjected to a 10% withholding tax, and whatever is net from that, it will be paid to you into your bank account as an investor. So you will not get 6.03%. You will get maybe slightly lower than that, maybe some 8 to 10% lower than 6.3%. So you will get, to me, I will roughly get, assuming there's no COVID-19, I will get around 5+% in dividend yield. And if it's after COVID-19, I won't get 4.6. I will get probably maybe somewhere 4.1, 4.2%. That's what I would expect. All right. That's just the rough calculation, the ballpark calculation. Now, conclusion, let's put all of them together and let's see what we can find. So number one, if we base on growth, if we base on this particular framework, what I will find is this, okay? Sunway REIT, since its IPO, right, it has actually grown its property portfolio from 3.5 billion ringgit, 8 properties, 3.5 billion ringgit, to 17 properties, 8.5 billion ringgit, 3.5 to 8.5. Okay, so it has actually a good track record of pursuing growth, and moreover, it is actually pursuing, it is continue to pursue growth with the renovation of Sunway Carnival, the purchase of Sunway Pinnacle, and as well as the refurbishment at the Sunway Hotel Resort and Spa. All right, so that is the growth element. When it comes to stability, it is actually quite diversified as a REIT in terms of property type. It has 1,207 tenants that is contributing income to Sunway REIT, and it kind of like has a balanced structure between short-term leases with its shopping malls and long-term lease structures with its university, industrial property, and as well as hospital. The Sunway Medical Center, it has a 10-year lease structure, so which is actually very long term. All right, so it kind of like has a long term balance with short term kind of a stability in terms of lease structure. And when it comes to financial results from 2012 to 2019, it did very well. 2020 is an exceptional year because 2020, because of COVID-19, their financial results have been kind of like impacted. And because of that, right, the valuation, if you look at the top right corner, valuation in terms of PB is trading at its lowest PB ratio. And when it comes to dividend yield, understandably because of COVID-19, if you are looking at it based on the COVID-19 after, I mean to say if you're basing it because of COVID-19's DPU, your dividend yield will be around 4+%. But if you want to assume that there's no COVID-19, if you want to base it on the actual business performance of this summary REIT without COVID-19, then I think you should get around 5+% in net distribution yield. But is 5%, is that 5% attractive enough for you to buy summary REIT? That one I'll leave that to you to decide, and I'll leave that to you to actually decide whether or not this is a good deal for you. But the thing is that this is how I would like to share, and how I actually use the framework to actually guide my own investment decision. Okay, so this is how you use the framework. And with that, I have ended my case study. And of course, this is actually not a what do you call a recommendation, not a recommendation to buy or sell, hold on to summary REIT. All right, because we believe that all investment decisions should be made by yourself, and please do exercise independent thinking and judgment when it comes to all this kind of stuff. And with that, I would like to pass back the control to Shane. So Shane.
Okay, great. Thank you very much. Well, let me take back the presenter control. So if any question to ask Ian, you can write in the Q&A box. Ian will do his best to answer your question. All right, I see that the first question on my screen, which I've put it into the slide, which is Ian, what are the criteria to consider in REIT post COVID-19? This is asked by Q.
The four criteria lah: growth, stability, valuation, and yield lah. So these are the four. Is actually whether with or without COVID-19, right? I will just go by the. It will still be the same form, because the same form, right, is supposed to help you to build a portfolio, right, that is resilient in anything lah. Economic crisis, political crisis, pandemic crisis. With that frame, you're supposed to build a framework to build a portfolio that is sustainable in all of these conditions.
Okay, cool. So the next question is by David. Due to COVID-19 impact and new normal implementation, it can be foreseen that majorities of the retail shop had decided to move out from the retail mall due to their sales had dropped from the previous. Okay, does retail REIT still have better prospect in the coming 1 to 2 years?
Okay, so therefore, as you can see, that's why summary REIT, just now we do the calculation of PB and the PB ratio and the dividend yield, right, or the distribution yield. That's why the PB is trading at its lowest all-time low, and then the distribution yield, it seems to be either all-time high, which means to say a lot of people are not so confident lah. Okay, that's what the market says. But from an investor point of view, I would say that okay, it depends. Okay, it's very hard to say. I wouldn't say shopping malls will just evaporate out of thin air lah. All right, that is not the case lah. Okay, so the reference point that I can actually say is maybe we can use SARS as an example. So the SARS, which happened like maybe, I don't know, 17 years ago. All right, 17 years ago we have SARS, and there's a lot of fear and panic because of that. So does that mean that shopping malls and the retail malls are going to close shop because of that? I don't see it lah. I don't see it happening. All right, I wouldn't say the sales will go up, or I wouldn't speculate how the sales performance will be like over the next 1 or 2 years, but I would say they won't actually just evaporate out of thin air lah.
Okay.
Yeah.
Thank you so much for your answer. So the
Okay.
third question is from Murugus Warren. Do you look into technical charts for REITs?
Okay. So just now the whole purpose of this presentation, the first thing that you look at is actually the objective of why you want to build your portfolio. So if your objective is for the long term, like me, all right, I like to just collect passive income from my stock portfolio and stuff like that. So the answer is no, because the technical charts doesn't help me to fulfill my objective lah. And if you are the type who looks at technical charts, right, perhaps you may want to ask yourself what's your whole reasoning for looking into technical charts ah? Is it for trading purposes or short-term gains or whatsoever? So you may want to look at your objective to decide whether or not you should look into technical charts. But for me, no, I don't look at technical charts.
Okay. The next question is, how do you get the lowest average and highest PB ratio? Like in which point of the year that you take the share price?
Okay, so for example, let's start off with P means price, B means book value, right? So the book value, let's start off with the book value. So we have the book value for, let's say, for summary REIT, right? The financial year ends at 30th June. So it means to say it's 30th June 2015, 16, 17, 18, 19, 20. Okay, so you take the book value or the net asset value at the time at 30th June of every single year. Okay, and then what you do is that you also compile the stock price, the closing stock price of 30th June of 30th June 2015, 16, 17, 18, 19, 20. Okay, then you calculate the PB as at, if it's 2015, then you take the stock price, the closing stock price of 2015, you divide it with the book value or the net asset value of 2015, 30th June 2015, to get the PB ratio as at 2015. Then you do the same for 16, 17, 18, 19, 20. All right. Then after you can actually get the lowest, average, and highest.
Okay.
Mm.
So the next question is by Chu. Compared to the Sun REIT and X REIT, in terms of 5-year is compound annual growth rate revenue and also 5-year compound annual growth rate net profit, which one is higher?
That one, okay lah.
Also quite popular REIT.
Okay lah. So both are actually quite comparable lah. But I would say, I don't have the figures right now for some. I could not say I don't have lah. I have the figures. It's just that I couldn't recall it in the back of my mind right now. So I would say both do have CAGR. I would use net profit for a REIT. It's supposed to be distributable income, all right, than net profit, because net profit will consist of the capital gains and stuff like that. I would say, I do not know lah. Very hard to pick between the two. Maybe Axis REIT, I don't know. But that one is just a wild guess. All right, you can actually take the annual report and verify the details, verify the data. But both has achieved growth, definitely.
Okay, both are actually fundamentally very strong REITs. So in terms of who is higher, then it leaves it to you to find out. Okay. All right, so let me put in the next question.
Okay.
So the next question is, heard Sunway REIT is going for DRP soon. How would this impact the income distribution in the future?
The impact can be minimal. Okay. But here's the thing lah. Where have you heard of this income distribute, I mean to say the DRP thing from Sunway REIT? Okay, what do you mean by heard? Okay, so right now, if I were to say, I'm going to go to the company announcement as I'm doing right now.
Oh,
So far,
do you need them to see your screen? If yes, I make you a presenter.
Okay, is it necessary, or I just make it very quick? I'm just looking at I'm just looking at it just to verify lah. I mean to say because I never heard of it. And so here's the thing lah, okay? Because to me, right, as an investor, right, the facts is very important one, you know. It's like all the presentation slides that I do, uh, it's all based on stuff that I can actually verify it from the end report and the quarterly reports or the presentation slides from summary REIT. Heard is not exactly a nice heard is actually hearsay lah, all right? If you're going to base your investment decision on this hearsay, right, it may not be too helpful lah. That's what I would like to say lah. But assuming that summary REIT is going to have DRP soon, right? The income distribution shouldn't alter that much, if you ask me.
Okay, so that is your answer. So
Yeah,
next question is how does Sunway REIT yield compare with other REITs? Can you comment a bit on that? That's by Lim Neng.
okay, it depends. All right, summary REIT, it depends on stock price. Very hard to say. Okay, right now, I would say right, summary REIT is doing around 5-6%, and then we have it depends on that. Okay, other REITs means that if you want to compare with Axis, then Axis of course will yield a bit lower lah, because the stock price has actually increased quite a fair bit lah. Because these days it seems like industrial REITs like Axis REIT is on the trend lah. All right, for some reason lah, for especially times like this lah. All right, so the yield for Axis REIT will be comparatively be lower than some REITs, not because Axis REIT is bad, it's because Axis REIT has gone up in price. Okay, and of course you can compare it with IGB REIT, which I believe that IGB REIT, the yield will be lower than some REIT. All right, simply because I do not know why people tend to favor IGB REIT over Sunway REIT. Well, that's why, because of the price, IGB will be a bit lower than Sunway REIT, and so as KLCC. All right, KLCC REIT or KLCC staple securities will have a little bit lower REIT. I mean, a bit lower yield as compared to Sunway REIT because of the price. What are the REITs? I think LRCA maybe more or less how would I say, comparable. And then the rest I don't look at it lah, because the rest is like, you shouldn't, before you compare the yield, right, the tip is to actually compare the quality of the REIT first. So if you want to talk about Sunway REIT versus Hectare, right, then you compare the quality first. All right, you compare the quality, then only we talk about the yield. Because here's the thing lah. I will review to you. Let me share with you lah, a mistake that I've made in the past when it comes to REIT investment, so that you won't repeat. All right, you won't actually repeat the same mistake that I made. What I did was, last time when I invest in REIT, all right, I tend to go for REITs that have higher yield. All right, and because of that, I tend to compromise on what? On the quality of the REIT, which is a mistake. All right, this is because after that I learned that, after that I made a mistake and I lost some money because of that. Okay, some I lost a little bit, some I lost a little bit simply because although the price dropped, but I still collect I was compensated with dividends. So the dividends actually offsetted my capital losses. So it's like how I say, ends up with nothing lah, or I lost a little bit of money. All right, but the lesson from it is that you shouldn't actually compromise on the quality of the REIT, which means the strength of the portfolio of the property portfolio of the REIT, over chasing high yields. Quality is of essence. So which means if you have a REIT which gives you 4 to 5% in yield, but it's of good quality, versus a shitty yield, or I shouldn't use the word shitty lah, let's say an inferior quality kind of yield, which is giving me 7 or 8% in dividend yield, I'll still go with the 4 to 5% one because of the quality.
Okay, thank you so much. That leads to the next questions. Is it good to consider Hectare REIT with its dividend yield of 13%?
Good question. So the question is this: have you been to Subang Parade? So if you are in town, if you're in town, come to Subang Parade. Just have a walk. Just have a walk about. You see, the beauty about retail REITs is something like this. You can actually visit the shopping mall and go and have a walk about. From there, you have a feel whether or not you want to invest in that REIT. Okay. So to me, Hectare REIT, what are the properties? We have Subang Parade, Mahkota Parade, Wetex Parade, and two shopping malls in Kedah, and what else? And there's one more which is in Segamat, Johor. All right. So if you're in town, just go and have a look at that property. You can actually also trace the annual report. So you think about it lah. Okay. You can actually think about it. Which of these two has better quality? So if you happen to be in Subang, or you are Budak Subang Jaya, then you just go to the two properties Sunway Pyramid. Go walk about Sunway Pyramid and Subang Parade. You know the difference. Then from there you can actually tell whether or not you want which of the two REITs you want to invest into lah.
Okay, very sensible answer. Okay. Yeah.
Turun Padang lah.
All right. The next question is, I just want to ask for the lease structure, will it be shown in the annual report, or is there a minimum term for it? Like maybe it's better if it's more than 2 years.
The answer is yes. And
okay.
That's why I would encourage you to read the annual report of a REIT before investing into it, because it will tell you about the lease structure. So the answer is yes.
Okay, cool. Okay, let's do the next question. This is by our friend Hafiz. Okay, how many percentage of REITs should we have in our portfolio?
Ya itu bergantung lah. Bergantung lah. Okay, so it really depends. All right, what you are trying to aim. What are you trying to do with your portfolio? Okay, so if you're a dividend investor, then of course you'll have a higher percentage. Okay, you'll have a higher percentage of REITs inside your portfolio. Okay, but then with that said, the thing is this lah. In Malaysia, you have 17 REITs. Not all of them are good, but we have some which is of good quality. And from that some which is of good quality, which one is being offered at a good price? All right, that one will limit you to maybe a few stocks which you can count with your fingers. All right, so it depends on whether you want to base more than 50% of your portfolio on this, or you just want to have something. That one, there's no hard rule for it. So yang itu bergantunglah kepada plan pelaburan sendiri. Yeah.
Okay. Let's see the next questions. If you were to pick two REITs to buy, what will they be and why? Okay, wow.
Malaysia one. Actually, we are not supposed to give. We are not supposed to give any recommendation.
Yeah, but this you might, if you are to invest, like if you were to invest from your personal selection criteria, of course it cannot be construed as an investment advice
So this is a trick question, because okay, let's assume it's just Malaysian REIT lah. Okay, I won't tell you what I will buy today, but I will tell you what I would love to own. Okay, I would prefer. Okay, Axis is one. All right, Axis is one, but then the price is like a bit too high lah. So it's already like, I wish it actually. Of course, if I can get Axis REIT at a good price, it will be very good. All right, so that's one. All right, Sunway is also, and Sunway can be another one. All right, Sunway can be another one. But if I can pick two more just out of, but there's two more REITs lah. If you I will consider it as more like a FD kind of REIT lah, because it doesn't provide any growth lah. Because these two are actually quite passive when it comes to pursuing growth, but it is actually quite stable, which is IGB and KLCC. So these two is more like, okay lah, you buy just to collect the dividends lah, and that's about it lah. So yeah, these are the four that I will consider. But if I'm a Muslim, like just now we have Hafiz on the show, actually your choices are even more restricted, because the Sharia compliant one would be Axis, Al Arca, and then we have KLCC, and we have the Amanah, and we have the two Amanah thingy. So you have just 4 or 5. I will probably pick any. I'll probably apart from the Amanah one, let's exclude the Amanah one. So we have KLCC, Axis, and Al Arca, right? You can actually just pick and choose from the 3 lah, whichever you prefer. Because summary REIT is not Sharia. Yep.
Yeah, okay. So the next question is, how do you assess the REIT management, as the management is one of the key, to the REIT investment?
Financial record lah. Financial result. So REIT management, right? You want 2 things ma, growth and stability. So how do you assess growth? Find out from their annual report what exactly they have done in the past to grow the business. Oh. That's one way. Second way is the financial ma. Financial is everything, all right? Because without the financial records, without good financial results, right, how are they going to pay you the dividends? Because at the end of the day, you want dividends. So the next way to assess the management team of a REIT is to look at the company's or the REIT's financial results. And of course, the third thing is like, what is their future plan, all right? Because you want the management to not just rely on past growth, you want it to continue to grow in the future, because you don't just want to get the present level of dividends, but you want your dividends to grow over time. So you want to look at the future. What exactly are they planning to do in the future to actually how would I say, grow the business? But of course, Sunway REIT is a bit special because it's a REIT whereby the major unit holder is Sunway itself, Sunway Berhad itself, which is a property developer. All right. So this will work a little bit of an advantage towards Sunway REIT because Sunway Berhad develops the property, and then Sunway REIT may buy over the properties owned by Sunway Berhad after they have been well developed and lease it to the tenants. Yeah. So these are the 2 ways.
Okay. Next question is, which part of the annual report or quarterly report do you refer to for the information in the presentation on future growth initiative?
Chairman's statement. And of course, summary REIT, right? Actually, it's not hard to find. Just download, you'll find it one lah. All right. It's either at the chairman's statement, or you can just go to the property manager's report. All right. It's all written there one. For summary REIT, actually for REITs or any stocks that have future growth initiatives, right? They want to tell you one. All right. Simply because right, if they think that this thing is something that is exciting, that actually reveals the ambition to grow, they want to tell you. All right. Because they want you to invest in their company. So that's why they are willing to spend some time, do some coloring, make sure that the annual report is well designed to actually tell you about all these growth initiatives. The stocks that don't have any growth initiative, they won't tell you lah, because they have got nothing to tell you. So don't worry of not finding it lah. It's very easy to find it in the annual report and the quarterly report. You just need initiative, and the information will be given to you.
Okay. The next question is it time to sell the REITs if the REITs announce rights issue? This is by King Jie.
I don't know, because rights issue, right? It depends from time. It depends on why they come out with the rights issue lah. Okay, sometimes you see the thing is this lah. Some REITs are okay. How they get the best tax benefit, right, is this: the distributable income, right? Whatever they report, the distributable income, they will pay 90% out of it as income distribution or dividends to the investors. That's how they get the tax advantage of a REIT. Okay, and because they actually pay out their income as dividends, right? So if they want to pursue a growth initiative, then one way is that they will borrow from the bank to buy a piece of property, or another way is that they will announce a rights issue, all right, to raise funds from existing shareholder so that they can buy the piece of property. So if you say that the REIT, so to answer this question, right, I would say this lah. If let's say the REIT is of good quality and they're buying good stuff lah, they're really buying good properties in the and because they are trying to do some fundraising campaign like rights issue to actually buy good properties, then I think it's okay. But if let's say after you look at the rights issue, you say, oh yeah, this property I cannot buy one day, it's a lousy property and it's gonna be what, detrimental, all right, it's gonna be hazardous or cancer to the REIT, then no lah, then of course then you may have the option to sell off the REIT law. All right, and the third one is that if the REIT happens to announce the rights issue so that they can actually fund, so that they can pay off their existing debt, and it's a lousy REIT, then of course actually I'm not too sure why you invest in that REIT in the first place, so maybe you can consider selling the REIT law. So these are the three instances that could happen when the REITs announce the rights issue.
All right. The next question is there consistency in the way REITs book values are calculated? Is there a tendency for books values to be overestimated? This is by Peter.
This one, it depends on the professional valuer that they engage lah. Typically, they use it depends on how they value the properties lah. Typically, they will use the income or the cash flow method of the discounted cash flow method or the income method of valuing the properties lah. Okay, so it depends on what is the formula for calculating the valuation of the properties lah. Okay, but that is just, so I would say to answer this question, right, I do not know, all right, because I do not know whether or not professional valuers will use a technique that will actually cook up the books. I do not know, all right, but safe to say that if you want to know more about this, right, you can take out the annual reports and you just read what exactly is the formula in greater detail, how they do it, and then from there you will know whether or not the REIT has the tendency to cook up their books lah. Okay, but if let's say you don't have so much time to actually look into this, all right, or you want a shortcut method, right, just use the net asset value per unit. As long as it is growing, it will be good enough lah. If let's say the REIT tend to cook his books and still couldn't increase the net asset value per unit on a consistent basis, then something is very wrong with the REIT already lah. Then you should actually think twice about what to do with your REIT if you happen to hold that REIT. Yep.
Okay. So the next question is, how does the interest rate reduction by Bank Negara impact the REIT?
So this one is actually, okay, it depends. Like for example, when it comes to debt, borrowings of a REIT, they got two parts one. They got two types of loan. The first one is that the loan, right, the interest rate is fixed one. Or the second type is floating interest rate. So that one, it will go up and down depending on Bank Negara. Okay, most of the REITs, right, if they want some stability in their interest rate, they will either go with the fixed rate or they will take the floating rate and they will have interest rate swap so that they can actually more or less fix their interest rate. All right, but typically for most REITs, they will have a balance of half lah, either half or they will have a little bit more proportion of their interest, all right, based on fixed rate. So any reduction in interest rate, right, I think it's helpful for the REIT, okay? But not too much lah, because most of the REITs are based on fixed ma. The floating rate, which is the one that benefits from the reduction of interest rate by Bank Negara, that one may save a little bit of interest cost lah, but that's about it lah. All right, it doesn't. I wouldn't say it's the biggest factor that will impact the REIT at the moment, but it does help a little bit. That's all.
Okay, thank you so much, Ian, for your wonderful sharing on what is a REIT and your investment strategy when it comes to REIT. So in short, REIT is an investment vehicle that will help us to buy into a pool of properties that can fetch us a good rental yield. Because just imagine if you want to buy a property at a prime location, it will cost you a lot of money. But if you invest in REIT will allow you to buy a unit that will be one of the shareholders of a pool of properties that the REIT owns. So allow us to buy a property without being without really go to manage a property, because REIT will hire a property manager to manage a property for you, and at the same time you can still get a rental income from the properties, maybe in prime location or industrial properties that's leased out to the manufacturers. Okay, so that's REIT, and REIT also has the advantage of being tax more efficient, because if they declare more than 90% of their income in the form of dividend, then they are exempted from the corporate tax, but only you need to pay a bit of individual personal dividend withholding tax for this REIT. So yeah, so we have concluded today's session, but before we talk about next session, just want to introduce to you Bursa Academy. I think every session I talk about Bursa Academy, and it's time for you to learn more. If on Bursa Academy is a comprehensive one-stop e-learning platform that aims to provide investors with a continuous and holistic learning journey, simplified, user-friendly, accessible anywhere, anytime, your own pace. In Bursa Academy, we have a lot of articles, articles, tutorials, courses, and also webinar recordings. And on the Bursa Academy, you can also find when is the next webinar that Bursa Malaysia hosts for you. Just head over to www.bursamarketplace.com. So that's where you can find a lot of learnings for you to continuously update you to become a savvy investor. So for our next webinar, we have this webinar in Mandarin called 股票整合活动. It means it's share consolidation corporate exercise. So in the next webinar, which is happening on this Wednesday, 8:30 to 10 o'clock, we are going to delve deeper into how this corporate exercise share consolidation affect investor. Okay, so just head over to the link that I shared in the chat group, so you can register for our next webinar on this Wednesday. All right, so we will see you on this Wednesday. Okay, thank you so much, Ian, for this wonderful sharing on REITs, property investment via REITs. Hope all of you here learned to know how to invest in REITs better by today's session. So hope to see you all on Wednesday. Okay, this is Shen Chu signing off. Bye bye, everybody.
Bye bye.
Thanks, Ian.
All right, bye Shane.
Yeah.